Okay, so in the interest of time, I think we'll go ahead and we'll get started here. Thank you all for joining us today. I'd like to welcome you to today's webinar discussing secondary marketing strategies for the current rate environment. This is part of the CWDL webinar series on key mortgage industry topics for our clients and friends of the industry. Speaking of friends of the industry, we are extremely excited to have our guests and our industry experts, Ben Itkin, Managing Partner of Sales for MCT, and Azad Rafat, Senior Director of MSR Services from MCT. They will be joining Mark Wilson, Founder and Managing Partner at CWDL, as well as Dustin Pfluger, Partner of Mortgage Banking at CWDL. A couple of background housekeeping items. Please feel free to type any questions in the Q&A area. We're going to do our best to get them all answered. If we don't, we will certainly circle back up with any leftover questions. That being said, we have lots to talk about, and let's get started.
Well, thanks, Casey. So thank you guys. Thank you, Azad and Ben, for joining us today. It's been a couple months since we've done one. It's been, I think, over a year since we've done one with you guys. So again, thank you guys for jumping on and doing this today. I think we have a lot to talk about given what's on. So just so everybody knows the kind of the flow of it today, we're gonna jump into a couple different topics, mostly focusing around hedging, execution, what's going on out there in the secondary market world. And then also talk about MSRs, valuations, what's happening there, what's happening with sales, just overall MSR topics. And then at the end, if we have time, we're going to touch a little bit just on overall profitability, what we're seeing in our client base, what the clients that are profitable are doing versus, the ones that aren't. So yeah, we got a lot to cover here. So with that, I guess we'll kind of jump into it. So I guess just overall, Ben, probably for you, it's been, I guess the last few months, probably this whole year almost has been very volatile, as everybody knows. And just if you can talk just to start us out, on this, but kind of what's driving that volatility, what's behind it, what kind of goes into that, and what's making it go, so nuts right now.
Sure, Dustin. I feel like I'm probably going to be saying some things that everybody knows, but just to give us, I guess, a recap or a starting point for the conversation. So tons of volatility right now, and it's funny to look at the situation when the pandemic that's kind of on the the backside, or at least we're hoping it's on the backside, is the least of the factors that's driving the volatility. Although we're rolling into the winter, so everybody's got their fingers crossed that we don't run into situations that are going to create additional headwinds for us. But we got kind of the remnants of the pandemic. Obviously, we've got geopolitical issues going on right now, with the war in Ukraine and kind of the implications with the different countries that are involved and our interactions with those countries. Probably, I guess, first and foremost really is going to be just the Fed's quagmire at this point, where we're all struggling with inflation. Clearly, the Fed is tasked with trying to kind of tame the inflation, but at the same time, the tools that they're going to use to address the inflation are going to be the likely outcome from the medicine to cure the inflation is going to be pushing the economy towards a recession. So you've got this ongoing kind of balance between curing the inflation side and taking the risk that we're going to push towards this recession. And it's kind of an interesting situation with regard to just the kind of passage of information. So the market is so plugged in and so attentive to every clue that might give it some sort of insight as to what the Fed's actions are going to be. So it's not just what they do with the rate decisions. It's the Fed talk. Every time anybody makes a comment, we get a reaction in the market. It's all of the market data or economic data that comes in. So it seems like we've got kind of this weekly, if not daily, flow of information that everybody kind of reads the tea leaves and then predicts what the Fed's actions are going to be. This whole time you've got the kind of psychological aspect to it, where the Fed's intent to slow the economy down is with raising the interest rates to kind of stymie employment to some degree and stop investment or expansion. The market, if you look at the inverted yield curve, kind of indicates that a lot of folks feel like they know the recession's the other side and the Fed's going to stop and go the other direction, and they're acting as such. So the Fed, has to be, very, direct and hawkish in their comments in order to sway behaviors. You've got this kind of constant struggle between the actions that they want to see in terms of economic response and their contention with this risk of going into the again on the other side with the recession. So they're probably overtly hawkish because they're not getting the slowdown that they're anticipating. And then you got this additional layer, frankly, on the mortgage side beyond the rest of the economy, in that we're all tied so closely to the MBS market. And so on mortgage-backed securities, we've got this Treasury MBS spread. We're all probably aware that the Fed has been supporting the mortgage-backed security market for over a decade now. They very recently stopped with that support. They're no longer purchasing the bonds. So that adds another layer of not only pressure pushing rates up on the mortgage side beyond that of the treasuries, but again, volatility and exactly what the implications of them coming out and how the market's going to react to that additional supply, as well as to be frank, right now they're sitting on 2.7 trillion in the balance sheet of MBS. Everybody thinks that they're going to sit tight and just let it organically bleed off. But, if they decide to hasten things, they could become a seller of mortgage-backed securities. So there's a lot of factors at play that are really driving up the volatility right now.
Okay. Thanks. I think that was a good summary in that. I mean, Azad, we're going to get into MSRs specifically later, but anything else you wanted to add just on volatility around the MSR side, or anything else, driving that side?
Definitely. Thank you for having me on this call. I appreciate it. What we're seeing on our side, same thing, similar to the yield curve being inverted, and it's creating a lot of volatility on the MSR value. However, we're seeing a slowdown in MSR value growth. We started noticing that since June month end, May month end, we started seeing a leveling of that MSR value. Even though mortgage rates may rise, 50 basis point, 100 basis point, the value gain with that is, does not correlate to that increase in the mortgage rates. We start seeing, even though, just to give you an example, from August, September month end, we saw mortgage rates rise about 75 basis points, but in more MSR values, we only saw somewhere between 2 to 5 basis point gain in value. Historically, let's say about a year ago, if you see 75 basis point gain, you would probably see 25 basis point gain in MSR value.
Okay. Well, good. Thanks. That was a good summary. We'll jump into a lot more into MSRs here in a second, but just wanted to have you speak on that before we jumped into hedging strategy and stuff like that. So I guess, Ben, with everything you brought up and said, I think, we talked a lot about this in the planning calls and stuff, but just overall, I mean, what is your strategy, or what is a good strategy for our clients when it comes to hedging in this market right now, with it being so volatile and whatnot? Can you just kind of talk through that a little bit?
Sure. Yeah, I've been having a lot of conversations with clients over the last few months. Clearly, everybody's having a hard time, and just kind of moving outside of just the capital market side, just kind of a macro view of what's going on in mortgage. It's kind of, I don't want to say unprecedented, but it's certainly beyond a lot of people's memories as to when margins were squeezed so much and volumes were falling like they have. So low volume, low margin. Everybody had to contend with this reality and make adjustments to right size the expense side of the equation to try and figure out a way to just kind of sustain until things get a little bit cleaner. So that backdrop in terms of my conversations with folks, I've had calls from clients where they say, look, we're calling all of our vendors and we're trying to figure out how to get rid of expenses that are kind of weighing on weighing on the income statement. And when we start chatting about it, we look at their situation. And just by way of example, you might have a guy that's doing 30 million a month right now, and we look at their lift over best efforts, which, by the way, has gotten squeezed for a lot of guys. The BE mandatory spread is still, it's decent, and we think it's going to get wider. We can get into that, but hedge costs are clearly higher than they've been in a while, and we can get into that as well. So, even by way of this particular example, if you got a guy that's making, say, 10 or 12 basis points, sorry. If you got a guy that's making 10 or 12 basis points lift over best efforts, and can you guys hear me?
Yeah. Yep.
Okay, good. If you got a guy that's making 10 or 12 basis points over best efforts and he's doing 30 million, you extrapolate that and you weigh that against the cost of paying a hedge advisor, and it makes sense to still engage in the hedge, even in the current economic environment for the vast majority of our guys. So, costs that, if you're cutting a cost just to cut it, but it's going to hit your revenue side, then the math might not work. That being said, every situation is a little bit different. So, with regard to what you can do, to improve hedge performance, there's a number of factors that we're kind of looking at, and we've tried to kind of design a lot of our systems and kind of strategies around it. So with the volatility that we're facing, the big problem really on the hedge side is with regard to the rise up in interest rates, where you can bump from coupon to coupon to coupon. And so as you're going onto a new coupon, there's a lack of liquidity within that coupon. So when you get up there, the bid-ask spreads are a lot wider. So it's expensive to get in and out of the coupon. A little bit less predictable in terms of the pricing. To compound that issue, right now with the volatility, it's not just an upward trend. It's an upward trend with dips, and then an upward trend, and then a dip. And with the dips, and when it comes back down again, it gives pause to the other side of the equation. So the guys that are buying the bonds. And so this kind of, ties into the issue that a lot of our clients are having, whether you're hedging or not, there's just not a lot of premium, so you say, hey, look, I can sell a higher rate, but give me a buy up. The reason there's not a buy up there is because, the market hasn't gotten confident that security is going to stick. If the buyer comes and buys a security and the market rallies again and it falls off, then they lost. So, the volatility is what's causing the issue there. So with those wide bid-ask spreads, what we try to do is give recommendations that help you avoid it. So, for starters, you probably want to look at trading to an outer month. So if you trade to an outer month, you avoid having to do rolls, and so you avoid getting into the bid-ask spreads. Another suggestion might be to consider assignments of trade. So when you assign a security to the end investor in the assignment, you avoid coming out of the security, and so again, you avoid that bid-ask spread issue with that. If you happen to be doing MBS, if you would create the MBS on swap, then you're not exposed to coming out of the security. And not near and dear to our heart, but certainly a conversation that we've had with folks when we talk about it. If you were to move back to a best effort type of hedge strategy, we would suggest looking at the extremity coupons, because again, those are the ones that are exposed to the coupon change. It's the highest cost in and out, and it also plays a factor with regard to durations. So when I'm talking about durations allow you to kind of cross hedge with different coupons than the ones that the loans might actually be mapped to. And, for the most part, durations are pretty reliable. If you run into heavy volatility, then that kind of compromises the use of the durations. Predicted response to market changes is not quite as good as expected. So again, it's the extremity coupons that really are challenging. So if you kind of push your highest note rates and your lowest note rates into either a best effort scenario, or if you have agency direct relationships, you could do a cash window forward on something like that. The central note rates that are right in the middle of the stack, those are, as usual, pretty easy to predict, and hedging is much easier.
So you brought up a point when we were talking about this, and it kind of goes along with the best what you just mentioned, moving to best efforts or whatever. But one thing you brought up is there may be clients that have historically may have been a little bit on the smaller size to hedge, but now that they've already gone through it all and they've gotten all set up and gone through the brain damage, that if they're making money, why not just keep hedging? I mean, can you just talk a little bit, like we were talking about in our conversation, just about that and just going through that? Because we've gotten that question probably from 10, 15 clients. So just, yeah, if you want to walk through that a little bit.
Yeah, no, I would say, when we're addressing new clients, if you got a smaller shop that's considering the move from best efforts to mandatory, we typically say, look, you want to hedge at least 10 million. So meaning hedgeable product. So, if you're doing 3 or 4 million of jumbo or non-QM or something like that, that wouldn't, that wouldn't qualify. We'd say, let's talk at 10 million, because there is a learning curve to it. There's some expense to get the whole thing started, and you just want the juice to be worth the squeeze, so to speak. On the flip side of that, we've got clients that were doing 25 million previously, and now they're down to 7 or 8 million. And so the question comes up, and in that scenario, I would say, look, you've already felt the pain of the transition into the mandatory realm. Everybody learned their roles. You got to get your underwriters accustomed to underwriting to a more generic underwriting guideline. You got to get your accounting people used to reading the reports. Like you've already you've already gone through all of the difficulties of making the transition. And even on kind of the low end of our book, we got folks that are dancing. And again, BE mandatory lift over BE, I should say, is a little bit thinner just because of the high hedge costs. But most of them are floating, probably around the 10 to 15 basis point mark. We got some that are close to break even, and I would say to those guys, if you look at your historical performance and that hedging works for you, and you're just kind of breaking even, hedging is a it's a easier process on the capital markets department. It's just it gives you room for growth. BE is really, it's difficult to scale with best efforts. If you're already there and you're kind of swimming close to neutral, you're doing okay in what I would call probably one of the most difficult environments we've encountered in some time. In terms of, again, the BE mandatory spread itself, not just the lift over BE, because then you're netting out your hedge costs. The BE mandatory spread itself is actually it's decent. It's pretty close to historical norms, and we would expect that might actually widen, because the same difficulties we're talking about in terms of hedging in this environment, which raises your hedge costs, the aggregators are feeling it as well. And so you've got a scenario where a lot of these aggregators have excess capacity and they want loans. So, they're willing to kind of compromise, I don't want to say rational margin management, but they might not be charging the BE book quite as much as they should relative to mandatory, because they've got capacity and they want loans. But as the market normalizes itself, true hedge costs have to be accounted for. And so we'd expect those spreads to blow out for your buyers, just like they've blown out for you.
So do you see that happening for the foreseeable future? Like, I mean, do you see that, that spread still staying consistent, you talked about it a little bit earlier, you just talked about, do you see that, staying like it is for a while? I mean, is that something? Yeah, I guess that's the question.
The BE mandatory spread itself, or the single lift?
Yeah. The BE mandatory spread itself. Sorry. Yes, that.
Yeah. Again, I would expect that you'd see that blow out a bit. Just even on a micro level, with a particular aggregator, I would expect that their BE mandatory pricing would expand a bit as they get on top of the capacity surplus, I guess I'd say. But then on more of a macro level, we do see a lot of participants coming into the space. You got Wells Fargo saying, hey, we're slowing down on correspondent. At the same time, we're seeing an influx of would-be buyers on a smaller scale that are coming in. And frankly, it's easier for them to enter the space in the mandatory realm where they can look at a tape and throw a bid out, as opposed to having to hire an expansive sales force and go onesie twosie. And we've got tools to help kind of find that liquidity. So with that influx of liquidity there, as well as co-issue buyers coming in to Vogue, and we recently did an analysis, and we saw as of a week ago, the average price fetched on the co-issue side relative to our aggregator release had actually compressed to the point where they're almost on top of each other. So if that trend continues, you could see co-issues becoming a dominant execution. So that would again further blow out because you're not co-issuing best efforts. So we're I guess optimistic is something that a hedge advisor would say, but we're confident that the value proposition of being on the hedge side and doing a mandatory strategy is going to further extend itself. And then just stating the obvious, look, if you gotta, ultimately you should have your, if you're not already there, have your eye on the goal of having an agency direct relationship. We love all of our aggregator partners, but at the end of the day, if push comes to shove and an aggregator is forced to pull back, that was a lifeline for a lot of guys 2-3 years ago, having that agency direct relationship. So, I think that even if the aggregators are putting a value proposition out there and, it makes sense opportunistically to sell them, you should, by all means. If they've got a better execution than what you can achieve, and they can put a price in front of you that makes sense, and there's relationship and support. But it's nice to have the agencies in your back pocket at a minimum.
Well, that's good. That's good note there. We got two questions right now to talk, because I think they're related somewhat. One from same guy, just talk about the 30-year conventional rates at about 7. Can you just talk a little bit on the liquidity, in the 6.5 and 6 versus the 5.5 TBAs? And then in the same question related, with low SRPs right now, what does that mean to the investor? Does that mean that they're not expecting this level for to remain the same for the next 2 to 3 years, or does it mean something else? Or what are your thoughts on, I guess, both of those? And then I have a question on the first one. Yeah, I think we've touched on the first one.
I can't remember about those.
Yeah.
So the higher note rates, again, speaking to the higher note rates, it's difficult to hedge the higher note rates because of the lack of liquidity in those higher coupons. So to say you don't want to offer them, that's a difficult choice, and certainly originators aren't going to appreciate it. So I think that a number of guys have opted on the very high note rates to take those best efforts. If you've got it on a rate sheet, you go ahead and lock it in and not struggle with it. As well, if you're of scale where you've got an agency direct relationship, you can do a cash window forward, and then you don't have to worry about the liquidity issue. And again, the liquidity issue translates into, do I get my face ripped off when I try to get out of this thing because the bid ask spreads? So you can kind of address it that way as well. But yeah, clearly you get into the 7+ note rates, and if everything just stabilized right here, you can anticipate that the market will come, and you'll see those the ability to offer a premium because you'll get that spread. But right now there's everybody is concerned that we get a low mark on CPI, and then all of a sudden we're rallying, and then those securities disappear again. So it's just until we get that stability, like that's the difficult time.
So one thing we haven't talked about much, we didn't talk about much too on our planning calls, but just, this question that came up, what are you seeing with pull-throughs, across your customers? I mean, the question was that they've seen theirs drop, and, been volatile as well. Are you seeing that pretty consistently? Or just what's happening out there with the pull through side of it?
Well, if there's a silver lining, most production now is purchases, which lends itself to a little bit more predictable and stable pull through. So there's that side of it. Yeah, look, it's something to be focused on. We don't have a ton of guys that are really having too difficult of a time with pull through. I guess if we go back a month or so ago when the market was rallying, there was a situation where everybody is just paying such close attention, even consumers at this point, to the market rates that it's going to give you some data points that would indicate that pull-throughs are not as strong as you might expect, and as well, it's going to force these originators to really pay close attention to their renegotiation policies again. But I think that's kind of a blip, and if we were to run pull-through expectations going forward, we wouldn't let that too heavily influence prescribed hedge recommendations.
Yeah, and I even to that point, we've talked with clients on that sometimes more than you would imagine, and if they're comparing certain originators to others and finding out if there's a pull through difference at one with similar credit qualities, it's an opportunity for management to discover where the difference is and how they can improve that, which can be a significant amount of money to the bottom line. So definitely an area to look at, an important indicator, and a good way to compare your internal originations group with one another, figure out some are better than others.
So a couple more questions, Ben, for you that we had pop up, and then we'll move on to the MSR topic and leave you alone for a minute. So question coming from, the question is basically they're getting questions from their sales folks of how do they get premium pricing? And is there any premium pricing out there? If they're seeing it from competitors or whatnot, how are they doing it? Are they doing it through higher MSR values? What are they doing? So I guess it's kind of two questions they asked, but I'm trying to combine them all into one there.
Yeah. I mean, it's a mystery. For sure. Anybody that's got purview into the TBA market, you could see that the intra-coupon spreads are not great when you start getting into the higher coupons. I think that you got to be, I guess, cognizant of borrower benefit. It's not my place to point it out, but there's somewhat of a buy-up, and certainly it can be the story can be told to the borrower that hey, I can get you some cash back, but on historical terms, or cash towards closing or whatever, but on historical terms, we all know that it's pretty modest. So I think it's case by case on how you manage it. The guys that are offering pricing that seems kind of nonsensical on the higher note rates, all I could say is yeah, either it's supplemented by some other motivation. They're recognizing that it doesn't make as much economic sense as you might think it makes for your firm, or perhaps they have some sort of arrangement that's a boutique arrangement with an entity that's looking specifically for that product. I can tell you this, we're seeing a lot of activity and having conversations with a lot of non-agency entities that are sniffing around some of these note rates now, particularly on the higher LLPA deals, like the non-owners and whatnot. And it seemed like this was going to come into vogue a year ago, and it settled down, and now those conversations are robust. And so we have our BAM marketplace, which is kind of a forum where our clients can show out tapes to less common investors. And again, a lot of the conversations we're having are with it's either private money or the intention is to go with a private label security where again, the math is starting to make sense there. So more to come there, but I think that's definitely something we're going to be seeing more of in the future.
Got it. Okay. And then the last question for you, Ben, that they popped up. You made a point earlier that the bid-ask spreads aren't too bad on the 5.5 or 6 coupon. What are your thoughts on cross hedging versus locking BE or doing a Fannie Mae cash forward type arrangement?
Yeah, so cross hedging, and we definitely do, some degree of cross hedging, but it is a little bit of a pick your poison situation, right? Because you rely upon the durations to tell you how much to hedge with a more liquid and actively traded security on a loan that's on a higher coupon or mapped to a higher coupon. The problem is with the volatility, when it's significant volatility, those durations, don't always perform as well as you'd like them to. So, there's a little bit of an art to it and not just a science, where you got to make a decision on what to do with it. Clearly if you did a cash forward as opposed to cross hedging it, that sounds great, other than now you're tied into selling that loan to the agency. If you best X'd and for whatever reason somebody had an axe, now you're committed to that execution. So there's pros and cons to the different scenarios. Even if you're hedging with a higher coupon, again, we chatted a little bit about AOT. A lot of the major aggregators now will accept an assignment on a trade, and that's that gives you the same benefit as the cash forward. You're not going to be exposed to that bid ask. When you sell the loan, you can assign that security and it's off your books. So we've got a lot of tools, I guess, in the tool bag to help kind of mitigate the situation. I'd like to say more so than a lot of our competitors. The whole assignment technology is kind of unique to MCT. Not that you can't assign if you're somewhere else, but our system completely automates the process. It points out the opportunity to assign because it knows your blotter, and when you're about to trade to an aggregator, it'll come back and say, hey, any of these trades are eligible, click a button and we'll automate the tri-party for you. So it makes it, you're almost remiss if you're not doing it. And a lot of guys that are active in it will actually incorporate that bid-ask spread into their best execution. The understanding that here I can assign and here I can. So it's there's no one single answer to it. It's just you got to be I think diligent and pay attention to your loan sales, pay attention to your policies. I guess I'm veering off course a little bit here, but for that matter, lock desk is so important. Are you making exceptions that you ought not be making in underwriting? If you got loans that are 2.5 months old and it's got a rate that's 1.5% below market, do you make that exception? If it's an exception, again, you just it's time to pay attention on a loan by loan basis to things, because a single loan that's 5 points out of the money can cost you $50,000. So it's.
Yep, for sure. We've seen that, and we've seen that a lot with our clients that do a lot of construction stuff and what's going on in that world. But that's probably a whole topic we could talk on for a while. So I guess with that, Ben, feel free to chime in where you want to here, but we'll jump over kind of the MSR stuffs and topic, I guess. So Azad, I guess just start off just overall, just a general kind of, we talked about the volatility, obviously, but just a picture of what you're seeing on the MSR side. Just give us a little update there, and we can get into some specific questions here in just a bit.
Definitely. Thank you so much. MSR values, as I mentioned earlier, been increasing steadily over the last year and a half, basically. And what we saw in the market, an aggressive bidding on bulk MSR, co-issue MSR, and that peaked around May, June at about 5.5 multiple. And what we also saw, a divergence between the market value and fair value. Traditionally, market value tends to be somewhere around the fair value within plus minus 5 basis points. Because as of mid last year, probably a little bit earlier, we started seeing that divergence where the market value started drifting farther higher than the fair value. And we saw somewhere between 10 to 20 basis points in some cases on the market value bids. But if you look at the bulk bids, if you dissect that bulk bid, you will see that some of the brokers and the pricing that came up with had a recapture component to that value. And that recapture value was somewhere between 10 to 15 basis points. And if you strip that out, that market value will be in line with what we consider the fair value. But you add that recapture to it, it kind of brings it much, much higher. And unfortunately, that recapture potential has evaporated since the beginning of the year. So that's why you see market values right now more in line of fair values. Still within 5, to 7 basis points or so. So things are aligning better. We're seeing healthy fair values in the 4.5 multiple range, somewhere between 110 to 120 basis points, depending on the characteristics of the portfolios, depending on the average UPB, WACC, and things like that will dictate that level. But we're seeing healthy multiples for conventional product. The same thing for Ginnie Maes, even though Ginnie Maes we started seeing some weakness recently, but still healthy in the somewhere between 3.5 to 4 multiple. And in a few cases, bank retail product, very low WACC, lower than 3%. We're even seeing close, maybe slightly higher than 4 multiple in some cases. So the market's still healthy. Fair values are still healthy. We're not seeing any weakness in the underlying asset. And hopefully that will continue, and the trend should continue into at least towards the end of this year.
Can you go, because we have a wide range of people on this, we have I don't know, a few hundred people sitting on this, so there's probably a wide range of audience. Can you just discuss a little bit more, because I think some people in this thing may, well, what's the difference between market value and fair value? Can you just talk a little bit more about what the intricacies of both are, and in the most basic terms for us?
Sure. Fair value, as everybody understands, is the net present value of cash flow, servicing cash flow, income, and expenses. And to achieve those fair value, one must or should use industry assumptions, i.e. acceptable assumptions that are used by bulk market, by broker surveys or other surveys like PwC and KPMG. There are multiple surveys out there that gives you an idea what those assumptions should look like. Just hypothetically, for conventional products, on average right now, we're seeing 9.5% discount rate. About 6 months ago, 8 months ago, we were seeing 8.5, 8.75. Right now, with rates moving up so high, those discount rates edged higher as well. So we're seeing that 9.5 more predominant than anything else. So that's what the fair value is driven by, those standard assumptions. Market value is really a perceived value by the buyer. You as an MSR holder may think the value of an X asset is 4.5 multiple, but you put it out on the market, somebody may bid 5 multiple for it. So it's a perception of the worth of that asset. And if you look the last few months, particularly prior to June, when you look at the bulk market activity, typically you would see somewhere between 8 to 12 bidders coming to the table, putting out bids on a specific bulk pool. About 70 to 80% of the bidders put their bids somewhere close what we consider fair value. But then you have one or two, 10 to 30%, will put out a bid that is about 10 to 20 basis points higher from the rest of the group. So those 2 or 3 bidders perceive that asset is worth more for different reasons than what that fair value is. And so it's really a market perception of the same asset that the owner of the MSR asset considers. If you consider it worth 4.5 internally, somebody else may consider it worth 5 multiple or 5.5 multiple, which we have seen over and over since June 2021 through May, June of 2022.
So in that case, I mean, well, what do you think? And this is, speculation. So if you don't want to comment, I'm fine. But what do you think the strategy is of those people that are trying to buy at a 10 to 20 basis points higher? Are they, and what's like the characteristics of them? If you can say, is it like a fund? Is it a other independents? Is it a public? Like I guess just curious on that.
Sure. Really depends on the buyer. I spoke to several of them. Your traditional buyers, traditional pay premium. The perception is any asset that was originated in 2020 and 2021 will have a longer duration, will stay on your books for a longer time than a 4% loan or a 4.5% loan. So if you look at historically, if you look at the prepayment activity going back to 2005 and even 2000, you will see the average, the rolling average, the 3-year rolling average and the 5-year rolling average, that prepayment is somewhere between 14% to 16%. But again, when you look at the underlying asset, it was on average about 4 to 5% interest rate for those loans. So given the assets that we have from 2020 and 2021, the average WACC on those is somewhere between 2.75 to 3.5. So the idea is those loans, even though traditionally you'll see 14%, 15% lifetime CPR, for those loans, newer loans will even be lower, like probably paying at 8% or 9% lifetime. So the duration for those loans, the projected duration will remain on the books much, much longer. And that's why they perceive it having a higher value. That's one idea. The other idea is, well, it's less risky, less default, less prepayment. So the yields they're going to assign when they price those loans are much, much lower. So to bring that value up. But then if you look at how the brokers look at it, they look at it from the recapture perspective. They will say this one will have a potential recapture, and that was the approach that was applied from mid 2021 through second quarter of 2022, adding 10 to 20 basis point, to 15 basis point and recapture value on top of that fair value. And that's what resulted in higher multiples. But the fact is, recapture shouldn't have, at least in my opinion, shouldn't have such high multiple worth in value. Probably somewhere between 2 to 6 basis point instead of the 10 to 15 basis point.
Got it. Okay. So who are you seeing out there right now? Who's, and obviously not names, but just types of companies? Who's buying and who's selling right now? I mean, is it everybody selling and few people are buying? Is there specific types buying? Like what's happening? Just general characteristics.
Yeah. Traditionally, you have the typical traditional buyers, the large entities, the well-known names in the industry. They paid premium. They were always active. But since June or July, most of those buyers already by that time already purchased what they budgeted to purchase during 2022. So now what remains, the same players, but they've been very picky about prices. They're not paying premium prices. They're paying what we consider fair value. But then you have others who missed out during that first half of the year, are stepping up and bidding aggressively, and not necessarily premium pricing, but somewhere in the 4.5 multiple range. And just to give you an idea, there were like a couple of players that I'm very familiar with. They're very active in the co-issue side, and from time to time they buy bulk side. But because of the co-issue market has dried up a little bit, so they're shifting gears, or shifted gears, start buying bulk MSR. And even though the prices were similar to what they used to pay on the co-issue side, but the fact that those assets they're buying have lower WAC, longer duration. So even though it's a little bit older, but at least the possibility of this asset to remain on your books for a long duration is valid. And so that's why the shift has occurred.
Got it. Okay. And then company's selling. I'm assuming they're just selling for cash flow purposes. They need the cash in the door now, and they're getting what they can and go. Yeah.
Yeah. As you are aware, during 2020, a lot of new companies started retaining loans for obvious reasons. And some of them decided they didn't grow fast enough or large enough. Those companies, like I'd say probably like within $500 million in UPB, they started liquidating their entire asset. Not all of them, but some of them for financial reasons. And others for business reasons. They're not really set out to be a servicer to begin with. So just to help them during that difficult time after the pandemic, they started retaining, and now they liquidated almost everything or most of what they already owned. That's one side of the equation. The other side, you have those companies who started retaining, and they like that type of business, and actually they continue to grow, and now they have somewhere between 3 to 5 billion, and they start learning the game and start originating and periodically sell $1 billion here, $750 million there, but they continue to grow, and there are a few of those that are selling on a regular basis. But then you have the traditional sellers that have been in the business for a long time, and they have accumulated over 5 billion, 10 billion. Every 4 or 5 months they would come to market with 2 to 4 billion to sell, just for taking advantage of the pricing, the current pricing, and reflecting that on their balance sheet, income statement, profitability. So, but then as we reach towards the end of this year, there's a lot of financial pressure right now for a lot of services, especially the smaller ones. So they're trying to sell not necessarily the entire portfolio, but some of their portfolio just to meet those financial objectives by year end. And actually, we started seeing some sellers getting ready to sell in January and February. They already started preparing themselves for those type of action.
Okay. I think really the last topic on the MSRs, and this will be very quick. I know we didn't want to cover much on this because we don't know, but just on the new Ginnie Mae, standards that are coming out in terms of liquidity and risk-based capital calculations and stuff like that. I think, we had a discussion before this that I think our client base, both sides, is fairly optimistic. It's not going to affect them that much. But just overall, is that your general consensus? You think it's, when those come out next September, that it's, not going to impact at least our client base that much? I know there's some more global issues may happen, but
there's some big ones going to affect quite a bit, but yeah.
Yeah, I mean, the feedback that I got from some of independent lenders, it's not going to impact us. And really, I mean, it could be that they haven't really looked into it yet deep enough to realize what those impacts would be. But the consensus right now is like, no worries. So, but yet to be seen.
Yeah, okay. Okay, yeah, I mean, I think, you know, I think the one that worries me is just the risk-based capital calculation, because it's a new calculation. It's, you know, and if you go out there, we had this discussion beforehand, if you go run this on public companies, it's, you know, half the public companies are in some trouble already right now. So
It's
So I
definitely
guess-
something to keep an eye on, though, right? Because I mean, if it comes to fruition in its current state, then you know, it could reshuffle the deck in terms of who's got appetite to buy the Ginnies, right?
Yeah, for sure, 100%. So yeah, so there'll be have to be some big guys unloading a lot of, you know, Ginny servicing if it does,
And if,
you know, actually
Yeah, and
become effective in September.
yeah, and you would think if that floods the market, the value of that servicing will go down, right? So you have to.
That's the thought. And actually, we already saw some, not necessarily a predominant approach, but we started seeing some Ginnie Mae trades getting weaker bids than what we saw about 2 months ago. And it could be for that reason, could be for other reasons, but definitely we're seeing those trends right now.
Okay. Okay, I guess, you know, we got just a little bit of time here, so let's just, I mean, Mark, I guess overall, just talk a little bit about profitability, you know, in our client base, and you know what we're seeing, and
Sure.
I mean, I guess just overall, what do you think, just profitability wise, in our you know, percentage of our client base, that kind of thing. What do you think we're seeing?
Yeah, and looking at our current client base, it appears about 25% of the clients we're tracking are profitable this year, which I think is good considering the difficulty that everybody's been facing. That being said, you know, I mean, 75% are either break even or losing money, and you know, I think some of that kind of goes back to clients being hesitant to right size their companies for the current market we're in. And we talk about this a lot. And I know as business owners and CEOs and CFOs and secondary people, a lot of it, there's a growth mindset, and resizing the company based on the current market can be very, very difficult. Looking even closer at our numbers, you know, the MBA put out last year that the average cost to produce or manufacture a loan was somewhere in the neighborhood of $10,500. I've heard other people say it's around $11,000, and then looking at some internal data, we see that running closer to $14,000. So it's still continuing to raise in a market that is difficult, and so I challenge everybody on this call that number should be working on going down. And I think that's because people are holding on to current production staff and some other areas in their company where they need to make these tough decisions and understand that the market is where they're at. So you know, and I think there's a whole other set of issues around that. I think, Dustin, we put out an email to some of our clients. They need to notify FHA and other users of the financial and let them know that there's been a decline in net worth in some other areas. But I go back to the 25% that are profitable. These are clients that are making the tough decisions and controlling what they can control. On this call, we talked a lot about the margins and interest rates, and then we have inventory and amount of volume. A lot of that isn't in our control. What is in control is our expenses and our structure and how we're operating the business. And this is where we get challenged. And so the good operators will realize that and make sure that they get to the right size as much as they can. Obviously, they went into this year with a pretty healthy balance sheet from 2020 and 2021. But it would be a shame to give that all back. The good news is when we have years like this, it leads to future years of lower interest rates and good opportunities. So being smart and getting us to that next moment of time is important. So.
Yeah, well, thanks. That was a very brief summary there. Obviously, we didn't have much time to get into that. So, yeah, I think with that, thank you, Assad. Thank you, Ben, for jumping on. It was obviously very timely. We had, at any given point, I think at one point we had over 200 participants. So, thank you, very much for being there. And Casey, you can kind of take us out. So.
Yeah, you bet. You bet. Thank you guys so much for joining us today. We will shoot, or I've already gotten a couple emails that people are wanting this recording. So we'll get that out probably by tomorrow. And at the end of each of these, we include a survey, and it's not just because we want you to tell us how wonderful we are. We're really trying to remain relevant and feed you guys the information that you need. What's that?
I only want those comments. I only want those comments.
Yeah, I know. I could hear him coming. Why was Mark on this call again? No, just
No. Everybody did great. Yeah. So let us know. Only tell Ben all the good things, but definitely let us know what you'd like to see next. And we're here to support. We know it's a tough time for our clients, and we really appreciate Azad and Ben for coming on today. So
Thank you for having us.
thank you all.
Appreciate you guys.
Thank you.
Thanks, guys.
Thank you, guys. Have a great day.
Bye.